In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at Intel. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For Intel this is minus 76% for the trailing 12 months. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, Intel have not hit our 10% free cash flow target, as it is minus 1%. Then we come to the next pillar, which is revenue. And this tells us how good the company is at generating income before deducting expenses. Their revenue is also down, at minus 2%. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has improved by a decent 7%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are not great at 1%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. Unfortunately, Intel can't use their free cash flow to pay off their debt, as they are operating at a loss. At present, with the information we have gathered, it tells us that Intel's key pillars are looking poor, but let's find out more. Tap the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. So let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 41%, which is good, as we like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is minus 1% and is well below our target of 14%, and explains why they are making a loss. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at minus 12.95% this looks very poor. As we are potential shareholders, we will now want to look at the average book value growth for the last few years. This is 8%, with the lowest point being last year at 4%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is minus 1%. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures. Looking at the chart, we can see that in 2019, Intel was trading at about $52 per share. They were trading more or less sideways, but in 2021, they began to sink. Then dipped, as the market had dipped, in 2022, but began to slowly regain some share value. However, they then started to rapidly drop again at the end of March, and went as low as $18.51. We can see the current market cap is $97.36 billion. They are currently generating $55.12 billion in revenue. Their net income is $975 million, and they have 4.28 billion shares outstanding. At present, their earnings per share tells us that for each share of stock, the company earned 23 cents of profit. And the current P ratio is 99.12, which suggests the company is a lot higher than the S&P 500, which has a PE of about 27. With the overall consensus being a hold. On average, the analysts believe that the price target should be about $32. It is also predicted that their sales growth will start again next year. Now I am going to show you how to create a valuation. I will use the current earnings per share of 23 cents. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give Intel a generous 10% growth rate. Then, I am going to give Intel an expensive estimated PE ratio of 80. After that, I will project these numbers forward by 10 years. Then I will reduce my return to just 5% for this investment. This then gives me an estimated future stock price of about $48 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $29. Then we apply a margin of safety. At 25% it gives me a buy price of about $22. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. Please consider sharing this video with someone you think will like it, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of $22 and sold in 10 years' time at our estimated future stock price of $48 would be 118%. But this is dependent on our assumptions for the company being correct. In addition, Intel provide an annual dividend of 50 cents. Their dividend growth is minus 32%, as they have reduced it. And their payout ratio is an unsustainable 217%. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Intel scored a record low for my channel of 1 out of 12. So not surprisingly, I will give them a cross. As for the past results, over the last few years their share price has been trading sideways, but has taken a significant dip over the last couple of years. Therefore, I will give them a cross. Analysts are signaling Intel is a hold, although they predict they will begin to grow again starting next year. However, I will give them a cross for this. Using the EPS growth model I used earlier on, we created a buy price of about $22. But it was overvalued and didn't provide much in the way of a return. Therefore, I will give the valuation a cross. According to Morningstar, Intel don't have a moat. So, I will give them a cross. My final overall rating is 0 out of 5 stars, and is a first for this channel as it hasn't received any stars at all. I have given this a category E rating within my own stock watch list, which puts it in my avoid pile. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.